Hey you. Hi everybody. Okay. Right. So let's just begin. So welcome guys to another webinar of our series. Today we're going to go down the path of technical analysis yet again. More specifically, we're going to talk about moving averages and by extension, we're going to introduce a few, in this kind of case, two strategies that you could deploy onto your charts and make much more informed decisions using moving averages. Okay, so again, we're gonna expand from where we left off last time. If I'm not mistaken, last time we talked about using RSI and Bollinger Bands together in on our charts to see what kind of information they broadcast to us, and from there onwards we managed to, let's just say, make a few base case scenarios of how you could approach trading when using these two indicators. In this kind of webinar, we're going to do moving averages. We're going to reintroduce what moving averages are, and we're going to again explain two strategies that you could deploy easily onto your charts, and from there onwards trade accordingly, okay, using moving averages. So I see people who have started to join in. Hello. And let's just begin because we are going to be pressed by time, unfortunately. So this is a quick risk warning and a disclaimer. I'm not going to go over this. The gist of this kind of slide is that this information does not contain any sort of investment advice or investment recommendations. It's purely for educational purposes only. And at the end of the day, the redistribution of this material is strictly prohibited. That's it. Let's go on. So technical analysis uses or has in its essence various different tools that we as technical analysts use in order to make much more informed decisions. Such tools are technical indicators, which fall under the bracket or the category of mechanical analysis. So these are computerized algorithms, if you would like, that you adjust the parameters accordingly, and they speed out specific information depending on what kind of technical indicator you are using. But besides these kind of mechanical, computerized kind of indications that you have also freely available tools and easy to use, such as that fall under the charting analysis kind of category, that are, for example, simple not bar charts, excuse me. They are simple support and resistance levels, so lines that you draw onto your chart in order to have an eye, to keep an eye on what kind of where the price action has gyrated in the past, with the expectation that in some point in time you're going to see those levels that have been significant in the past. Maybe they're going to be playing a significant role into the future as well. That's why you use support and resistance levels to keep an eye on these kind of key areas. And once you identify those key areas by using support and resistance levels, you can use them as entry or exit points. So pretty simple tools that you have in your disposal. Other tools are, for example, trend lines. Again, the main purpose is to identify the trend, and we have said this a million times so far. If you are a novice at trading, if this is your, let's just say, first month, year, whatever that is, uh, please go ahead and just learn how to trade the trend rather than just be the contrarian, because it's fun. So it's much more easier to learn and fine and refine your tools on, or let's just say, um, um, sharpen your tools by doing the simple stuff first. This is a big quote unquote on the simple aspect of things, which it's much more easier to trade the trend rather than just attempting to find where it's going to reverse. It's pretty much an established fact when it comes to trading. So remember, trend is your friend. So please go ahead and learn how to do that first, and you can go onwards and play the reversals. Obviously, you can do whatever you please. I'm not going to tell you what to do, but the point is, yes, it's much more easier if you would like, if you learn how to let's just say, comprehend where the market is moving by the usage of many different tools. You can be much more accurate when it comes to and much more profitable when it comes to your trading journey. So other tools that are freely available on the charting analysis kind of thing or aspect of things is learn how to properly identify chart patterns. There are a few universally accepted kind of and easy to spot kind of patterns that are telling you crucial information if you do your homework. We're talking about things that have been or patterns that have been arising time and time again, and traders tend to flock to these, tend to have, let's just say, a collective kind of mindset when it comes to the formation of these patterns. Once they are formed, they act in a specific, predictable manner. If you learn them as well, you can capitalize upon them. That's what it is. It's not written in stone that once a pattern is formed, that is the expected results going to follow. But yeah, probabilistically speaking, if you learn how to spot these kind of trends, you're going to be much more accurate when it comes to your trading journey. So these are a few things, a few aspects of the charting analysis, going back to the mechanical analysis that uses technical indicators, mechanical and computerized kind of algorithms. Today, we're going to talk about new moving averages. Super simple concept to understand, super easy to plot onto your chart, and relatively speaking, super simple to go ahead and make informed decisions using that information. Okay, other tools that fall under the mechanical analysis kind of categories are oscillators. We have talked about oscillators in the past. RSI is one, moving average convergence and divergence is another one, momentum is another one. So other tools are envelopes and bands. Bands, we have talked about it last webinar, Bollinger Bands. So trading bands is also another one. Many others. However, many other different indicators fall under these categories. However, these are not limited to, there are many other, and hopefully as we progress throughout this series, we can introduce many others as well to make, let's just say, add much more tools to our arsenals. Okay, so enough talking broadly and generally. Let's go back to the topic of the day. So mechanical analysis is being performed by the usage of moving averages, the topic of today, oscillators, envelopes and bands, and other technical indicators. So the aim of the technician, that the guy or gal that uses these kind of technical tools, is to establish market sentiment, not the trend, by the help of all these pre-mentioned tools. So excuse me for a sec. Technical analysts, or in other words, chartists, look for technical indicators in historical asset price data. This is what we do. We look at past or historical price action to judge entry and exit points for trades. Ultimately, this is our purpose, and the tools are these moving averages, oscillators, and bands, and all the other stuff. So there are several technical indicators that fall broadly into two main categories. These are what we call overlays, pretty simple to understand. They go on top of price action, and oscillators, they are usually found below the chart on a separate kind of window. So technical indicators are also known as purely technicals and are focused on trading data such as in order, price, volume, and open interest. These are the three key pillars of data that we use as technical analysts in order to make much more informed trades. So technical indicators are also commonly used by active traders, more specifically short-term traders, but mainly because they are designed to analyze short-term price action. But long-term investors may also use technical indicators to identify entry and exit points or keep track of where the market is headed at and how their long-term kind of position is behaving. Is it going with the trend? Am I positioned well enough to capture the uptrend or the downtrend, depending on the situation? Are there signs for a potential reversal, or is everything well and good? So that's how long-term traders are using technical indicators as well, mainly to keep an eye on the development of their trend and whether they have a valid kind of signals that the confirmations that the trend is going to continue going their way or not. Short-term traders are exploiting these kind of tools on the short-term basis, obviously, in order to capture in a much more speculative fashion gains from the market. Super, super helpful and useful to use these kind of tools on the short to medium kind of term. Less important so when it comes to the long term, mainly because long-term traders primarily rely on the fundamental aspect of things, fundamental data to make their decisions, and they keep technical analysis on, let's just say, on the sidelines once and every now and then they check upon charts to see how the trend is behaving, how the trades are evolving. Okay, so again, the split of this kind of category, the mechanical analysis category, you have on chart and off chart. Pretty self-explanatory. Off chart, they go below the chart. So relative strength index, the RSI, we've talked about it last week. Moving average, convergence and divergence, ADX, the average directional move, and momentum all go on a separate, panel below the chart. And on chart indicators, moving averages, the topic of the day. Bollinger Bands, Ichimoku clouds, parabolic SAR, and Fibonacci go on top of price action. So they are overlays. Okay, so they go on top of price action. You see on a visual example pretty shortly. Okay, so definition of mechanical moving averages. So moving averages is or are one of the most widely used technical indicators that are out there. So if a new trend has begun or if an old trend has ended, this is what is identified by moving averages. They're not telling you information about what's going to happen in the future. They compile information about the past and they tell you what has already happened. Okay, so no need for you to look for future signals from moving averages. They are conveying information about what has happened in the past. Lagging indicators, they compile information that has already happened. Okay, so it at the end of the day tracks the performance or the progress of a trend. So you use moving averages for confirmation about where the trend is headed at. Okay, not where it's gonna head towards to next. So it is the average at the end of the day of a certain body of data, hence the term average. So you use, for example, 10-day moving average. So you use the past 10 closings of that specific instrument's history, and the computerized version of this kind of technical indicator adds all those values together, those 10 past closes, and then software divides that by 10 and this spits out a value which keeps track on where the market is headed at, where the price action is headed at. So if a 10-day, for example, moving average is used, closing past days of the closing 10 days of this past period is used, and the body of data to be averaged is in a sense evolving over time. So you add on a new day and you extract from the equation the 10th day, the prior 10th day, and you move on, hence the term moving average. Okay, so by averaging these price data, you get a smooth line, if you like, or the line is produced, which is makes the visual experience of keeping track where the market is headed at much more easy. That's the whole purpose. So it's a visual illustration of where the market is headed at by the usage of moving averages. So you use moving averages to pretty much confirm that the market is headed either upside or downside or in a sideways fashion, not about where it's going to head towards to in the future. So a short-term moving average would hug the price action much more closely than the longer-term one. And you can see the visual illustration on the right-hand side of the slide. So the 10-day moving average is the black line, is much more closely fitted to the price action, obviously, because it uses a much more shorter time frame compared to the 200-day moving average, which compiles information about the past 200 closing days. So the line is not going to be as closely fit near the price action compared to a short-term one. So this is an easy guide for you to spot which is the short and which is the long-term moving average if you have at least two or multiple moving averages. So a short-term moving average would hug the price action much more closely than the long one, and the greater the number of periods used, the greater the smoothing. Okay, another easily spotted kind of fact. So the 10-day moving average, you can see it moves much more erratically compared to the 200-day moving average, which is a much more smoother line, obviously, because it compiles information about many, many other days, multiple days, larger than the short-term one, okay? So there are three types of moving averages. So what we call the simple moving average, which is the example we just outlined earlier on this slide. So you have 10 periods, you divide that by 10. This is the simple moving average. So every value out of those 10 has an equal weight. So none of them has much more importance than the other. So this is the simple, the basic moving average, which is not the same with the linearly weighted moving average or the exponentially smooth moving average. Of the last two, the WMA and the EMA, they place much more weight on the more recent kind of closings compared to the latest ones. The primary reason behind this is to get a much more appropriate kind of reflection of how price action has evolved or has performed in the near past compared to the later stages of the price action. That's why EMA is considered to be much more quote unquote superior to the simple moving average, is because it encompasses or it places much more weight on the much more recent periods in order for you to spot let's just say the reversals much more easily and much more quicker compared to the simple moving average. Again, is not future predicting, it's just telling you information about the recent past. It places much more emphasis on the recent past compared to the distant past, if you get the analogy of what I'm talking about here. Okay. So moving average, again, is a follower. It's not a leader. It follows the market and signals that the trend has begun, but only after that has happened. Please digest this. Okay. The sooner you digest this, the better. Because you're gonna abandon hope that the moving averages are something like a crystal ball that is telling you what is going to happen into the future. It does not. Please do not fall into this trap and think that moving average, a simple moving average or an exponential moving average, or using 2 or 3 or 4 moving averages is going to tell you about what's going to happen in the future. It does not. Okay. Again, because it compiles information about the past. So enough about this. Let's get to the gist of this, the main focus of today's session. Let's see how much time we have. Okay, we have another maybe 15, 20 minutes. So strategies by using in a sense, moving average strategies. So using one moving average is super, super simple, but it has its advantages, mainly because the less parameters you have, the less overwhelming you're going to feel in this kind of case. But at the end of the day, it's not that as good as using two moving strategies. So a single moving average. So using only one moving average. The idea here is that you use price action and one moving average. Those are the two pillars or the two main components of this kind of strategy. So when the market is, or whatever instrument you're looking at, is closing above the moving average line, that is perceived to be a bullish signal. And you can think about it in much more simple terms. Again, the moving average is compiling information about the past X periods that you have chosen. Let's just say there are 10. So the moving average has compiled all the information about the past 10 days. And in today's session, you see, for example, the price action breaking past that average. That means there is more interest by the bulls in those kind of in today's session compared to the prior session. That means this is an early signal that the bulls are beginning to, let's just say, awaken and taking the initiative of that price action, and they're gonna possibly push the price action to higher ground. This is not for sure. You are making an educated guess given the fact that you have seen price action breaking above this kind of moving average, this historic average of that kind of area or that level of price. Okay, so that's how you use the simple moving average and price action. Whenever you see the price action breaking above the moving average of your choice, that tends to be perceived to be a bullish signal. Therefore, you can treat it as a buy point at that point in time. Whereas when you see the moving average, when you see the price action breaking below the moving average, that is to be perceived as a bearish signal. So therefore, the signal in your eyes is that possibly the price action is going to fall to lower ground because the range of price action in that session has exceeded the prior range of that the moving average line is telling you about. Okay, so that's how you use, in a sense, one simple moving average and a price action in order to find signals for you to trade upon. Okay, so using two moving average is another strategy that many traders are using. Again, simple strategy, pretty simple. Is not advised to go ahead and just use only two moving average and averages and trade. You have many other tools at your disposal that you could use and see some sort of confluence or some sort of convergence of information that, let's just say, increases the odds of you making a much more informed choice. So in this case stage, we're going to keep it simple and use two moving averages. So the theory or the rationale behind this is that whenever you have a short-term moving average, and by the way, you need, when we talk about using two simple moving averages or two moving averages in order to create this kind of strategy, you need to have a short and a long, for example, moving average. You could, for example, use the simple or the short moving average being the 12 period or the 12 days, and the long one being the 26. So might be 10 days and 50 days, whatever that is, whatever the key ratio between the days of the small and the long moving averages are. The concept is that whenever you have the small moving averages, average crossing above the long-term moving average, this is considered to be a bullish sign. So therefore, whenever you see the SMA crossing above the LMA, the price action generates a buy signal. So you go long when you see this kind of crossover, which is what we call the golden cross. So SMA above LMA generates this buy signal. But whenever you see the SMA, the short-term moving average, crossing below the longer term moving average, that is considered to be a bearish signal, and therefore you get this the flag that you should go short. Okay, again, super simple ways to go out and trade the markets only using moving averages. At the end of the day, they are useful, yes, but it's much more nicer, much more accurate, it's much more efficient to use many other technical indicators alongside this kind of moving average and enhance its usefulness, if you will like, by taking into account momentum, for example, or sentiment in general, or the performance of volume in that kind of term, short term on that kind of scenario, to have let's just say much more higher degree of probability in your favor before you place trades by using only moving averages. So it's not that sophisticated, to be honest, but the confluence or the convergence of all these two indicators together makes you much more certain, again, in your own bias that the price action is going to either head to the upside or downside, depending on the performance of the instrument. Okay, so excuse me. This is a visual illustration of what the two simple moving average strategy is showcasing to you. Okay, so if I'm going to ask you guys now which one is the short-term moving average and which one is the long-term moving average, which one will you say is what? is which. So if you remember what we have said in the prior slide, so the moving average that tends to hug the price action much more closely compared to the other one is always the short-term moving average. In this kind of case, the green line here is the SMA, so the short-term moving average, and the blue line, because it's not fitting the price action much more neatly compared to the other one, is the LMA. So SMA, again, these are the two parameters that we want, or we use two moving average strategies. Okay, so this is the one, this is the other one. So how you go ahead and make informed decisions using only this information, nothing else. So remember when we said the small moving average crosses below the long-term moving average. So the green line crosses below the blue line, which is at this point right here. It has happened here as well. This generates a sell signal, okay? So whenever you see the SMA crossing below the LMA, the short-term moving average crosses below the long-term moving average, generates a sell signal. And you can clearly see here in this kind of scenario, this kind of example, which is dollar yen daily chart. It's kind of hazy, but yeah, I'm just spotting out which instrument we're talking about here. You have seen the price action falling rapidly after this kind of crossover. And now where is going to be your exit? You could use the traditional way of going at moving to usage of two moving average strategy. For example, if you see the crossover between the short-term moving average and the long-term moving average, in this kind of case, generates a sell signal. The exit signal would have been down here when you see, again, the short-term moving average crossing above the long-term moving average. So this could have been your sell, your entry point. This could have been your exit point. There are many ways to play this. So sell, you could do enter here the market, entry points, okay? And you could exit whenever you see the crossover, and you can clearly see here when the short-term moving average cross below the long-term moving average, we have what we call the bearish cross, okay? Or in other words, the death cross. Or in the flip side of the equation, whenever you see the short-term moving average crossing above the long-term moving average, you have what we call the bullish cross. This is generates a buy signal, or in other words, the golden cross. Okay, these are just terminologies that analysts, technical analysts, or traders use in order to, let's just say, communicate with each other. So this is the one, this is the other one. So from there onwards, another way of exiting the market, much more quicker if you don't have that much patience when it comes to your trading, could have been somewhere in here when you could have seen the first initial break of the short-term moving average, the price action moving average. So this is a hybrid way of going at things. Hybrid. So this is a hybrid model of two moving averages. So you could, yes, treat this as a sell signal, okay, and short the position right there, okay. And if you did not have that much of a trading horizon, let's just say from here until then, or wait for the next crossover, you could have exited the position whenever you have seen a convenient break above the short-term moving average of the price action. Remember, we're not talking about another crossover. We're talking between two moving averages. We are now dealing with a simple moving average, one moving average, and the price action. So this could have been your exit point right here. Okay. As soon as you see the price action breaking above, okay, remember, this is this scenario. That's why it's hybrid. So we're using, yes, two moving average strategy, two moving average as a strategy, but an adaptation, a hybridization of this kind of strategy. Instead of using the next point for you to exit the position, the next crossover for you to exit if you have entered here, the next possible or the much more shorter kind of decision for you to go ahead and exit the market if you are not patient enough and you want to close this position, make money, and move on to a different position. Could have been whenever you would have said you could have seen the price action breaking above this level. Okay, so this is a potential exit area for you to go ahead and close the position and move onwards, because you can see clearly from here onwards market kind of gyrates kind of aimlessly between these two bounds. Okay, so a consolidation has taken place irrespective of a spike of volatility afterwards and these kind of erratic movements. But at the end of the day, this is an also valid play. Okay, so treating using the crossovers as entry and exit points. The opposite side of the coin or the equation could have been after this. So you see the market, if you have exited, kind of again moving downwards, yes, but not with much radicality, if you will like. But another signal was created down there with the short-term moving average crossing above the long-term moving average. So the green line crossing above the blue line generates what we call the bullish cross. So in this kind of scenario, you buy. Okay, this is your entry point. And now if we treat this as a valid entry point and we have entered the market, let's just say somewhere in here after the confirmation, the bulls taking the initiative and pushing the price action to higher ground, where would have been our next exit point? In this kind of scenario, there was nowhere near a reason why for you to exit the position if you have entered somewhere here. Okay, no reason why, because this hybrid adjustment we just made down here of the break below the short-term moving average of the price action did not occur. On the contrary, we see support taking place at this level. So this is not a signal for you to exit the market. This is a signal for you to stay long enough in the market, even more in the market, because the price action is probably going to head to high ground after it has found support from this kind of moving average. So there is no signal inside from this kind of scenario here for you to go ahead and exit the market. If the price action at some point in this, at some point breaks below this kind of line, and it closes somewhere in here, crosses below, maybe we could consider this area right here as a valid exit, okay? Much like we have treated this area in the past, okay? For you to exit the position, because mainly you say, you know what, this is an over-exaggerated move. The buyers are super eager to push the price action to higher ground, but at some point in time, the conditions are going to become overbought. So maybe you could treat this, if that has happened, as an exit signal in a much more quicker way, because we don't see any sort of slowdown or a crossover inside, because the bulls are super eager to push the price action to high ground. So from this case, you go long here and wait for the next signal, that signal being the next crossover, which is not going to be bullish. Actually, it's going to be bearish. This is what is the signal for you to exit the end position after you have entered here using the golden cross as an entry, or whenever you have seen a break above the moving average of your choice, of the short-term moving average in this kind of case, which may be something like this. Okay, so again, using some simple moving average as super simple tools and strategy of going at trading. It's beneficial, yes. It gives you information, yes. But if you're going to take your trading journey to the next level, you're going to need to add more indications onto your chart. For example, an RSI, an oscillator such as an RSI indicator, which is going to be below your chart, telling you that, you know what, we have seen a divergence of the price action and the RSI readings, which is foretelling that an imminent pullback is going to take place. So if you are looking closely at RSI and you see a break below this moving average and you see the RSI telling you the same thing, that, you know what, the bears are entering the market and they're going to push the price action to lower ground, then you treat that as an exit signal, as an early exit signal, because you expect to see the price action falling rapidly much more quicker from that point onwards, etc. So a Bollinger Band may tell you other information as well. MACD may tell you different story as well. So combining all these technical indicators together is going to give you a much more holistic kind of view and much more accurate, more data setting, more accurate for you to go ahead and place much more informed decisions. Because remember, trading is a game about probability. So the high probability you have in your own scenario that this kind of instrument is bullish, so you have a bullish tilt or a bullish bias for this instrument, and all the other technical indicators you have deployed onto your chart tell you the same thing, then yes, hold the position for as long as you can and make the most amount of percentage gains. But if you have an assessment from moving averages and all the other 3, 4, 5, 6 technical indicators are telling you a different story, treat that difference as an early sign of you to get the hell out of that position, because the trend is going to reverse or has already reversed, and the moving averages have not yet confirmed that. Okay, so that's how we use moving averages. You're going to see that rationale, this base case kind of scenario that I'm just verbally reiterating right now on a visual illustration kind of scenario on a live environment. In a few weeks' time, you're going to see what I mean. We're going to do a live trading session together to see what I mean by this, how you judge whether to go long or short given the information you have available in front of you, for how long or under what circumstances I'm going to be considering to be closing my position if I have already opened the position. All that kind of stuff we're going to go through together to just see for yourselves how I am personally treating the markets and how I am trading accordingly. Okay, so unfortunately, guys, we're gonna have to cut this session short. I have some other pressing matters to attend. If you have any sort of questions, if something was not clear enough, please let me know in the chat before we finish this session. If not, hopefully this information has been beneficial for you, and hopefully you have learned something from this. Again, these are super simple concepts. The the quality of this webinar was chosen specifically to be super simple for novice traders. So some experienced traders might not find it as much important because they pretty much already know the information. But for those of you that are novice and amateur, or they're at the early stages of their trading journey, if this information is for some reason complicated for you, please send me as many questions as you like on the email or here before we go away, for you to just get the grasp of things and hopefully understand these things as early as possible and learn how to use them efficiently onto your trading journey. Okay, I see no questions, so I'm gonna just go ahead and assume that everything is correct. So in order, and you pretty much understood what we have presented here. So from my point of view, I have nothing else to say, guys. Thanks for watching, and hopefully we're going to see you on to the next week's webinar. Oh, I see Goodwin having a question. No? Let me see. You have... it's in the Q&A. Sorry. Sorry, I have the chat instead of Whoop, the Q&A. So what are the settings for the moving average? In this example, if I'm not mistaken, I have a 20 and a 50 day moving average because this is a daily chart. But on the day-to-day trading kind of activities that I have, I like the 12 and 26 kind of settings for parameters for periods. For some reason, it fits my way of looking at things. It's beneficial for me, might not be for you. You can, at the end of the day, these are not written in stone, these kind of adjustments when it comes to the parameters. You can use whatever you like, but let's just say if you're a long-term trader, you could use 50 and 200. If you're a short-term trader, you might use, for example, something like a 7 and a 14, or a 12 or a 26, or a 20 and a 50. The point here is to find the appropriate kind of multiple between the short and the long-term moving average that fits the way you see things importantly, okay? Again, this is purely subjective. The 12 and 26 that personally I'm using has some sort of empirical data to back the reason why you have the 12 and the 26, mainly because it has to do with the cycles, more specifically commodity cycles. They're kind of predictable, but also the beginning and ending of future contracts. It has some sort of significance, but it's slight, it's not that much. But yeah, you could use whatever you want. Okay. Personally, I like to use 12 and 26 at some point in time, and the 20 and 50 is something you also have as a second choice. At the end of the day, this is a few examples of what you can use depending on what kind of trader you're. Okay. Did I cover your question, your let's just say query? Was that helpful enough? If you have something else to ask, perfect. If not, I'll leave it here. All good? Okay. So nobody else is having any questions. I'm going to cut this session short, guys. Again, thanks for watching. Hopefully, we're going to catch you on to. Thanks for the thumbs up for the confirmation. And hopefully, we're going to see you on the next webinar. And hopefully, it's going to be fun. For the time being, take care, guys. Bye-bye. Ciao.